Good to have you back. Still talking commodities. Oil fell today amid worries over the outlook for demand for the latest signs that international trade disputes have been dragging on the global economy. Prices are pressured by ongoing worries about demand as the world's two largest oil consumers, US and China, continue in a trade war that could strongly impact oil demand growth. And joining me from our London studio to discuss this is a research analyst from FXTM, Lukman Otunuga. Lukman, it's good to have you and good morning. Now, gold price is struggling to keep above the $1,400 level. Tell us more about that.
Thank you for having me here today. Yes, looking at gold prices this morning, prices are struggling to keep above the psychological 1,400 point. However, gold investors are rubbing their hands and licking their lips because in the bigger term, the outlook for gold in the second half of 2019 points to further upside. Firstly, if you look at gold's performance in Q2, gold rallied roughly 9% and is set to increase even further thanks to geopolitical tensions, concerns of a slowing growth, dollar weakness, and many other factors supported appetite for the safe haven asset.
Indeed, Lukman. Now, what is the implication of the gold price struggle with regards to the US Federal Reserve on interest rates, you think?
So that's very, very interesting. So the reason why the outlook for gold is extremely positive is the fact that we have a chorus of central banks, including the Federal Reserve, that have signaled a willingness to cut interest rates if needed. Now, gold is a zero-yielding asset, so it tends to flourish and shine intensely in a low interest rate environment. So the reason why gold was a little bit lower today was the fact that the positive jobs report we saw last week did cause investors to evaluate the prospects of a rate cut. However, the Fed are going to be forced to cut interest rates in the second half of 2019, thanks to trade tensions and signs of slowing economic growth.
Indeed. Now, what drives the bullish nature of gold trading over time, despite the current scenario you've just explained?
What's driving the bullish scenario for gold is simply the fact that global sentiment is fragile. So when we look beyond this false sense of market stability, the main themes leaving investors on edge are still present. Although there was talks of US-China having a trade truce, in a bigger picture, there's still uncertainty over trade talks. World Bank and the IMF have already cut global growth forecasts. In the United Kingdom, we have Brexit. China's manufacturing is disappointing. In Europe, there's signs of slowing growth. So when we put all these factors together, investors are on edge and they'll rather park their cash in a safer investment rather than risky assets.
Indeed, Lukman. Now, let's take a look at oil prices and focusing on the US-Iran conflict. What has been the impact there lately, you think?
It's very interesting we speak about oil, and my take is OPEC versus US show, and OPEC is actually having a losing battle. If we look at the market reaction after OPEC Plus decided to extend production cut deal to March 2020, it says it all. The market reaction was quite flat, and the reason is because nothing has changed. Although geopolitical risks, geopolitical tensions can support oil prices higher, oil prices are going to remain subdued as long as concerns over slowing global growth remain present. It's just like trying to run a diesel car on petrol. It's going to go higher in the short term, but in the longer term, there's only so much higher it can go.
Very good. Now, are we likely to see more volatility of oil prices in the short term? I know you just mentioned it. Now, should this conflict in the Gulf be sustained? Iran is increasing its nuclear production in defiance of an earlier ban. What do you make of it?
Yes, we are going to see volatility in the near term. However, if you look at oil's reaction or oil's price action in recent months, the commodity is actually showing an increased insensitivity to geopolitical risk because this is all becoming old news. So what is really going to drive oil prices higher is more of the demand side rather than the supply side. So if we have reports of slowing global growth or even reports of US-China trade tensions easing, these factors are more likely to increase volatility in oil markets rather than geopolitical risks.
All right, now, coming back home, should countries like Nigeria be wary of situations in the Gulf on account of their dependence on oil revenue?
It's interesting you say that, and going back to the OPEC decision to extend production cuts, the biggest winners were actually emerging market oil importers, not exporters. The reason I say this is because countries like South Africa, India, Turkey that import oil as a form of growth are winners, because in the end, the outlook for oil points to downside. But yeah, Nigeria, Saudi Arabia, and other oil exporters that need to export oil for a form of growth should be worried, because for as long as concerns over slowing global growth continue to impact the demand for oil, the downside points to further losses.
Very good. And there's some positive valuation on the US dollar recently. Can you shed more light on that?
So when we're looking at the dollar, we can see that the dollar is still stumbling into the new week, trying to nurse the battle scars from last Friday's US jobs report. And for an extended period of time, I've been quite bearish or negative on the dollar. And the reason I'm saying this is because although the US jobs report did paint a positive picture of the US economy, when we look at data in general, especially in the manufacturing sector, the largest economy in the world is showing signs of trade tensions negatively impacting growth. The Federal Reserve have already signaled a willingness to cut interest rates. Although markets did get slightly ahead of themselves with the intensity of the rate cut, it becomes a matter of when rather than if. Now, should the Federal Reserve move forward with cutting interest rates, this would simply reduce the dollar's interest rate differentials between other major currencies, naturally weakening the dollar. So in H2, dollar weakness should become a major theme moving forward.
Indeed, but I still like your thoughts on the US-China trade imbroglio. How are the markets reacting to that recently, you think?
So when we look at the recent developments, this goes back to what I was saying about this false sense of market stability. Initially, there was a sense of optimism and jubilation after both the United States and China had a truce, but the recent reports of the US and the arms deal is going to create concerns over the future of trade talks. Now, these concerns are going to translate to market uncertainty, and naturally, in an uncertain environment, global equities and riskier assets and emerging markets will be in a firing line.
All right, and the oil prices from OPEC's projections, what do you make of the current scenario?
Going back to what I was saying, although they projected is very interesting, but my projection for oil prices for WTI crude to remain around $55. The reason I'm saying this is because for oil prices to either move up or down, we need to see a major change in theme. We have a situation where oil markets are not reacting as much as they did in the past to geopolitical tensions. What oil needs is a major shift in sentiment. So should we see change or increased optimism over a return of global growth, if trade tensions do ease, this should be enough to push oil prices back higher. But I remain negative on this, and my outlook for oil points to further downside. I'm looking around $50, $45, acting as a floor for 2009.
Very good, Lukman. Now, in your neck of the woods, talking about Brexit, what has been the impact so far, on the markets? And there's still a little bit of uncertainty as the two candidates, the election heats up.
Yeah, the impacts of Brexit are being felt in the United Kingdom, and it's really hitting sentiment. If you look at the recent economic reports, it's quite negative, and the Bank of England have already forecast that economic growth in the second quarter of 2019 is going to come to a complete standstill. So this continues to highlight how Brexit is impacting not only sentiment, but the British pound. Now, there's market speculation that the next Prime Minister could be Boris Johnson, and should this become reality, the British pound is at risk of collapsing like a house of cards, because this does raise the risk of the UK crashing out of the EU with no deal in place. But now, beyond October the 31st, this remains open to question. We don't know what the European Union is going to do. We don't know how far the pound is going to how far the pound is going to collapse, and how the UK economy is going to handle the sense of the UK actually leaving the EU with no deal in place. What I have to say is, though, uncertainty is the certainty when we're dealing with Brexit, and this will continue to negatively impact the pound's valuation.
Indeed, and beyond the pound's valuation, there is the issue of, still talking about the Brexit, as it were, the issue of companies moving to mainland Europe from the UK. What has been the situation there recently?
So going back to that, this is another key theme that may impact the UK, especially knowing that the UK is a major financial hub. And this goes back to such a scenario negatively impacting sentiment towards the UK economy and being reflected in the pound's valuation.
All right. Beyond that, how has the UK economy been able to cope with all of this? There's been some increase in some figures recently regarding some sectors of the economy, as it were. But overall, how would you gauge how the economy is reacting to the issue of Brexit so far?
I mean, overall, I was going back with the Brexit since it's been over 3 years since the original Brexit date, and we're still at where we started. There's so much uncertainty, and going back to answering your question, it's been reflected in UK economic fundamentals, the confidence index, overall sentiment in general. Now, what everyone's waiting for is, number one, the economic growth figures for the second quarter of 2019 and what the Bank of England does. Now, there has been suggestions that the Bank of England could move forward with cutting interest rates. Now, a rate cut will be supportive of growth potential because should the Bank of England cut interest rates, this would reduce credit card payments, reduce mortgage costs, and all of a sudden, consumers have more disposable income. And we know how important consumption is as an engine of growth for the UK economy. But we just still have to continue paying very close attention to see how things play out. The first thing is who becomes Prime Minister on July the 26th and how markets react to that.
Very good, Lukman. Now, do you think, briefly now, do you think the Bank of England was very cautious on its recent interest rate forecast?
Yeah, the Bank of England naturally did adopt a cautious stance because they are treading on a fine line right now. As going back to, it's not only sentiment remains fragile in the United Kingdom, but it's a global theme. It's a global theme, and what I feel is, even though there has been a rally or call for major central banks to signal a willingness to cut interest rates if needed, the likes of the Bank of England, the European Central Bank, the Bank of Japan, and other developed and developing central banks may simply be waiting for the Federal Reserve to pull the rate cut trigger before.
All right. Oh, very good. Lukman Otunuga, many thanks for your thoughts on that. We'll be right back after this break. Stay with us.